What should you know about index funds? Unlike mutual funds, index funds do not aim to beat the market, but aim to mimic the market's performance. Index funds offer lower management costs, known as expense ratios, than mutual funds since they don't require daily human management. Hello everyone and welcome to another video on our channel. In today's video, we're going to let you know some interesting facts and information about index funds. Yeah, you heard it right, so let's start our video. What exactly is an indexing investment? If you're looking to mimic the performance of a specific benchmark, an index fund is a sort of mutual fund or ETF that holds all of the securities in that benchmark. Of course, there are indexes and index funds for every market and investment strategy imaginable, with the S&P 500 being the best known. An index fund gives you access to a wide range of securities cheaply. Some index funds give you access to a wide range of securities in a single fund, which reduces your overall risk. You can create an asset allocation that meets your goals by investing in various index funds and track various indices. For example, you could invest 60% of your money in stock index funds and 40% in bond index funds. The mechanics of index-based funds. A benchmark index, such as the S&P 500 or the NASDAQ 100, is followed by index funds. A diversified portfolio is what you get when you invest in an index fund instead of picking individual stocks from the companies that make up the index. As an illustration, consider the S&P 500. It is one of the most widely used indices that measures the performance of the country's 500 largest corporations. One of the most popular funds is the S&P 500, which ties your investment to various companies. Index funds are less risky than individual stock holdings because they aim to replicate the same assets as the index they track. Additionally, market indices have an excellent track record as well. Although the S&P 500 tends to fluctuate, it has traditionally provided investors with a yearly return of almost 10% on average. It would help if you kept in mind that past performance does not guarantee future results. The passive investment includes indexing. Since the fund replicates an index investors don't have to pay as much attention to their stock and bond holdings. Since index funds are passive investments, they are distinct from mutual funds in this respect. Managers of mutual funds make investment decisions on your behalf. In mutual funds, investors aim for higher returns than those offered by the market, whereas the objective of index funds is to keep up with the market's performance over time. Index funds have lower expense ratios than mutual funds because they don't quite require daily human management. Investment in an index fund rather than a mutual fund can save you a lot of money in the long run, and as a result, increase your net worth over time. Many long-term investors use the dollar cost averaging method of investing, which involves making small regular investments into an S&P 500 index fund and then seeing their money rise over time. Index funds aren't always a better investment choice. An index fund or ETF that tracks the S&P 500 will see losses during a stock market downturn, just like the index itself. Investors in other index products tracking real estate, such as real estate investment trusts or emerging market stocks, could also suffer large losses in a broad sell-off like the 2008-2009 financial crisis. A manager's risk isn't a concern for index fund investors. If an active manager's investment choices in managing the fund result in a lower return than the benchmark, this is the risk they face. Sometimes the index fund provider will modify its tracking or switch to a new benchmark. It can reduce costs, or the fund can be more effective by implementing this strategy. Since mutual fund providers continue to fight on pricing, even if most buy and hold investors are unaffected, they should keep an eye on their index fund's holdings for changes like these. Investing in index funds doesn't ensure success. Investing in an index fund can't achieve investment or financial planning goals. Index funds are nothing more than a tool like any other investment product. It would help if you had a plan to get the most out of index funds, whether you use them purely or in conjunction with active funds. As part of an asset allocation strategy, index funds are excellent. Investing in index funds, at least the ones that track the most basic standards, is a pure form of investment. Many financial advisors use index funds to build portfolios tailored to their clients' risk tolerance and financial goals. Core and explore strategies where index funds make up most of the portfolio and active funds are selected to increase returns are also popular. Is an index fund a good investment option for you? Index funds have consistently outperformed other types of funds in total return, which is the most obvious advantage. Because they're passively managed, they typically have lower management fees than other types of funds. Rather than employing a manager who trades actively, an index fund's portfolio mirrors that of the designated index. The lower transaction costs of index funds come from holding investments until the index changes. These lower costs can have a significant impact on your long-term profitability. Buffett wrote in his 2014 shareholder letter that large institutional investors have long underperformed the unsophisticated sophisticated index fund investor who sat tight for decades. Fees have been a major factor. Many organizations outsource a lot of cash to consultants who then hand out recommendations for high-priced executives. A fool would play that game. Another tax benefit of investing in index funds: there may be hundreds or thousands of lots to choose from when selling particular security because the index fund purchases new lots whenever investors put money into the fund. There are a lot of advantages to this, including lower capital gains and lower taxes. Investing in an index fund is a good idea if you're looking to save money. Even though index funds tend to be less expensive than actively managed funds, some are less expensive than others. Well, that's all for today's video. Tell us in the comments section how this one was. I hope that you found this video interesting. If you want to see more videos like this, please consider subscribing for more. And don't forget to give comments and provide us with your valuable feedback. We'll see you in the next video with some more interesting facts and stories about economics. And until then, stay tuned.